Most people think a market system starts with a buy signal. It does not. A buy signal is somewhere in the middle. The real architecture starts much earlier, and it ends much later. Because if you skip the steps around the signal, the system can be precise and still make a bad decision. So let me show you the structure I built. Not the formulas, but the logic. The first block is market data. Price, volume, dates, corporate actions. Enough history to understand what happened before today. And that sounds obvious, right? But raw data is not automatically trustworthy. A row can be missing, a date can be duplicated, a split can make the chart look completely wrong, a ticker can change, a price can be stale. So before the system is allowed to look for anything, the data has to pass validation. And that is the second block. The program checks whether the information is complete, fresh, and internally consistent. Because if the evidence is wrong, every answer after that can be wrong in a very convincing way. Once the data is usable, the next block is the signal engine. This is where the system asks whether something's meaningful change in an individual stock. Did momentum improve? Did a pullback resolve? Did a trend continue? Did a sell condition fall and reset? Did the original reason for holding a position begin to weaken? There is not one universal question. Different market situations require different tests. The signal engine classifies these situations, but qualifying is not the same as deserving a position. And this is where ranking comes in. Imagine 20 stocks all pass some kind of test on the same day. Great, but you can't treat every 20 as equal. The ranking block decides what deserves attention first. It compares the candidates using the approved strategy and priority. Ranking doesn't guarantee an outcome. It solves a simpler problem. Where should the review begin? Now the architecture has data, validation, signals, and rankings. A lot of systems stop there. That doesn't make sense because the next decision depends on what you already own. So the next block is portfolio state. What positions are open? How long have they been held? Which ones have been supported by the process? How much capital is committed? How much room is actually available? A new candidate does not exist in isolation. It has to compete with the portfolio that already exists. And that leads into the risk block. The system has to decide how much exposure makes sense, not just whether a stock passed a test. Position size matters, concentration matters, available cash matters, the type of asset matters, the condition of the existing portfolio matters. A good idea at the wrong size can still become a bad decision. Then the system checks exits, and this is important. Exits come first, okay? Because before asking what to add, the review asks what must come off. A position can exit because risk increased, because a stop or invalidation rule was reached, because profit needed protection, or because the portfolio needed to rotate towards stronger opportunities. The reasons can always vary, but the sequence does not. So you must review what must leave before deciding what shall enter. Now we reach the action block. At this point, the system calls the broad authority. Buy, sell, do nothing. That third outcome is essential. A system that always has to produce activity is not discipline. It's just performing. Sometimes the data is valid, the scan runs, the signature checked, the portfolio is reviewed, and the correct result is still nothing qualifies strongly to take action on. And that's valid. Once the actions are determined, the next block is the operator review. The raw engine might produce a large amount of internal information, but a person should not have to read all of it. So the system compresses the result into the decisions that matter. What needs attention? What is an exit? What surfaced as a candidate? What rank higher? What's already open? What risk or capacity limits are visible? This is where the newsletter comes in. The newsletter isn't the engine at all. It's the interface to the engine. It's the output. It turns the architecture into a structured review a person can actually use. And the final block is still human judgment. The system doesn't place a trade for the user. It does not know the user's full financial situation. It doesn't remove the uncertainties. The person still decides what, if anything, to do in their own brokerage. So the complete flow looks like this: market data, validation, signal classification, ranking, portfolio state, risk sizing, exits, actions, operator review, human decision. So each block exists because the block before it cannot fully answer the question. Data can't tell you whether it's trustworthy. A signal can't tell you whether it deserves priority. A ranking can't tell you whether you have capacity. A candidate cannot tell you what you should leave first. And software can't make a personal financial decision for another human. That's a systems engineering lesson here. Don't begin with the feature you want to show. Begin with the failure you want to prevent. Then add the next block, only when the previous block cannot protect the system by itself. And that is the architecture behind Mount Inflection at a high level. It's not one magical signal. It's a chain of checks, priorities, risk decisions, and human review. The output is not supposed to tell you the future. It's just supposed to help you make the next decision with the same discipline every time.